All right, welcome to On Main Street with Rick Amato. With the Super Bowl coming up, we thought this might be a good time to talk about your retirement income. Why, you say? Well, there are some analogies in how a team prepares to win the Super Bowl and how individuals can limit their losses and protect retirement while taking withdrawals during retirement.
Mm.
Okay, what does all that mean? We're about to find out. Join me at this time from Westlake Village, California, is someone who's been a financial strategist for over 40 plus years. He says he puts you in a driver's seat of wealth and retirement. Let's welcome back John Grace. John, good to see you.
Good to be with you again, Rick.
As you say, it's there's an analogy here between a team preparing to win this a football game, Super Bowl in this case,
Yeah.
and people having a successful retirement strategy on their which withdrawing their income. Elaborate.
Yes. Yes. Yeah. Well, everybody loves sports, all ages, both genders, whatever. Okay. Everybody loves sports. And let's look at what championship teams have in common with savvy investors.
Yeah.
And the answer is it's all about the defense. Okay. Nobody wants a Hail Mary to get back in the game. And the defense strategies, no matter which game you're talking about, there are defensive strategies for every sports team you can think of. And they are placed in advance of the game getting underway. They're not trying to figure it out as the game is underway. The strategies were placed before the game began. And it's that defensive strategy that will prove, I'm sure, very valuable for Super Bowl Sunday. And that's the history of the Super Bowls. It was the championship defense that won the game. The offense gets all of the noise and the media and the attention, right? Highs of whatever you like to think of, the investment that you put your money in is at all-time highs. Well, guess what? It turns upside down in a flash. And by the way, I did say back in October that it would not surprise me to see that we reached a peak with crypto as measured by Bitcoin. I believe at the beginning of October 2025, it's about 120,000, 25,000. Last I looked today, it's about 73,000. We think that this may be a number to watch because what often happens, Rick, is when things go through the roof, the first things that come through the floor. Okay. Even with the stock market, the old adage is the market takes the stairs up and the elevator down. It goes down twice as fast as the market went up. So this is an important thing for people to understand and to put some strategies in place, particularly those who are taking withdrawals.
Yeah. So give us some examples of what it means to be defensive when you're in
Yeah.
retirement and taking withdrawals.
Okay, so let's paint the picture, right? Because I want to say this. What do they say? People in the South, the people in the North talk too fast. You must be up to something. So let's do this in real time and take it slow so people can grasp what we're talking. And let's understand that when you throw a dart in the dark and whatever you threw the dart on has gone to new highs, you get complacent and you're not ready for us to look like Wile E. Coyote. How low can we go? So if you had a couple of businesses and you sold them, say the wife had one, the husband had one, they totaled $5 million. God bless you. That's what you netted after the taxes. God bless you. And 4% withdrawal is typically the speed at which most advisors suggest you take income out. 4% on 5 million is 200,000. I know for me, maybe for you, certainly for me, maybe not for you, but 200,000 in retirement would be okay. I would be just fine with that. But now let's remember, to get there, you had to walk through and experience not one, but two 50% losses in the same decade. 0002, 0809. That's when you were making contributions to build this business or this portfolio up to this magnificent $5 million. And those losses were actually an asset to you. They were a blessing. Kind of like, you're at the seashore. When do you get the seashells? When the tide goes out, pick up more seashells, collect them in your bag of tricks, and you're having a wonderful time. But now you're in a whole different scenario. Now you're trying to live off of this money. And if you wake up to, you're in Belgium, this is a real case, husband and wife, she's an attorney. He sold a business, she sold a business. They came up, netted about $5 million. They love going. She likes to go to the Philippines. He likes going back home to Belgium, actually. They wake up with their $5 million when they get there. And by the 2 weeks into their vacation for a month, they see, oh my goodness, the 5 million just got cut by half to 2.5. And if we're accustomed to this 200,000, as we have become accustomed to this 200,000, what does that mean we have to do to the withdrawal rate? Well, it's got to double, right? You got to go from 4% to 8% on 2.5 to bring in that 200,000 you become accustomed to. And now let's look at that in terms of a scenario. You had 5, now you're at 2.5. You were taking out at 4, now you're taking out at 8. Does this look like it's going to have a happy ending as you and I are trying to live to age 100 after our life savings just got cut in half?
You're banging into that principle. That's not a good thing.
No, that's a huge eraser. And you need something, particularly if the money was in or is in traditional retirement accounts, where the withdrawal rate does what? It's set at 73. I think at 73, the withdrawal rate was 3.77% for 2025. We were just meeting with clients. She's 84, he's 86. The withdrawal rates for her are 5.6, I believe, and for him, they are 6.2. Okay. So notice the point is that the withdrawal rate keeps going up regardless of what happened to your life savings, whether the market went through the roof or it went to a very hot place. Okay. The withdrawal percentage creeps up every year thanks to the Internal Revenue Service. So to me, this is a great conversation to have with you and your audience, Rick, so that people can see, wait a minute, there's like the drain won't stop. Well, how do I slow this drain down? Or what can I do to reduce my experience of losses so that as I'm trying to get to 100, we don't run out of money before we run out of time, as opposed to needing that Hail Mary pass. It doesn't happen. And now, like you said, you're running through your principal. The recovery, well, the odds just got not so good.
No. What are some things that people can do to minimize the impact of being in that position?
Great question. Great question. This isn't our first time to the rodeo. Okay. So some of the things that we have a 1-2 punch. Well, it's a 1-2 punch, but first we want folks to determine as a percentage what kind of loss is acceptable to you. I don't want to insult folks. Are you conservative, moderate, or aggressive? I don't understand the question. You don't understand the answer. We're not having a conversation that makes really any sense. Let's go through a series of questions that's designed with both percentages and dollar amounts to say, if you got 5 million, where is your loss limit? Is it 10? Is it 70? Let's figure it out. Let's make a goal. But now it's a specific number, right? Let's say it's 12. Okay. And then let's see how your portfolio treated you. If you had the same positions in first quarter 2025 to 2008, 2022, what did your account do to you? In 2008, 2022, 8, for example, the market was off 37. Many of the passive investment accounts were off over 40%, taking about 5 years to get back to even, assuming you didn't take a withdrawal. If for some reason you were able to reduce your losses in 08 to, let's say, 20% or less, okay, well, now all you need to do is net 25, 26% to get back to even, which is possible when we do two things in our experience. One, we, as I say, develop a goal of limiting losses. Okay, what kind of loss can you live with? Or they say, find yourself in a ditch, stop digging. Okay, so that's number one. Number two is put active management strategies in the equation. Most of the money for most investors are in passively managed, 5% cash, 95%, some combination of bonds and stocks. Well, in 08, you might have been very comfortable starting January 08, 5% cash, 95% in investments, stocks and bonds, finishing 08 where it's completely flipped. Behind the scenes, as the market's reaching new lows every day, you see your portfolio not stay stuck in risk assets. We take those chairs off the Titanic, go to cash, go to the money market account, And now it's only 5% invested, 95% cash by year end 2008. And that's where some folks who found ways of doing this saw their portfolios reduced by 20% as opposed to 30 or 40% or more. And then starting March 9th, 2009, I think the movie Wax On, Wax Off, Karate Kid, remember that one? You know, you wanted to wax off of stocks in '08. And starting March of '09, you wanted to wax on. You wanted all those gains. So now you want to flip it back. 5% cash, 95% invested. And that way the money gets reduced out of the safe positions back into risky assets. Now we may see, and some folks have, who are following these principles, a gain of about 25, 26% in the very next year. So the first step is active management. And the second one is greater diversification.
Hmm.
And I like to use the example of Yale just as an example, not as a model, but the Yale endowment. Most people are astonished to find that the Yale endowment, 46 billion, I believe, in assets, is there's only 3% of the portfolio sitting in U.S. stocks. Huh? That's all?
Wow.
Yeah, that's low, right? We can all agree that's low. Most people would not imagine it would be that low. And we've been studying the Yale endowment and their work. So we watch what they do. We as retail investors can apply all the principles. We can learn from the best and the brightest. And the first thing is notice how small their exposure is to U.S. stocks, just as an example. And maybe more importantly, how they have 5, 6, 7 different legs of investments underneath their portfolio. Well, we can agree if you're 60-40, that might be a 2-legged stool. And if you've got 5 or 6 or 7 legs, well, and no position is more than 20, 24%, you're not making any big bets, are you? You've got probably a more smoother ride than making big bets and then waking up and discovering, oh, shucks, that's an OS moment.
Yeah. That's really interesting, John, and really informative and eye-opening. For those who might say, "Wait a minute, it sounds like if he went from 95% to 5 back to 95, that sounds like market timing, and that sounds dangerous." What would you
Yes.
say to those who say that?
Yeah, well, I would say it's not market timing. Think of it this way. Like I say, the Karate Kid, wax on, wax off. You want a team that has this mindset that's looking at your money daily, asking and answering the question, is it wax on or wax off? We're not looking ahead. We're looking at what the market did today, what it's doing this week. Here's an example. 2025 first quarter, markets look like we were going for a serious upchuck, okay? But it wasn't market timing. It was looking at where, think of it this way, there's always a bull market somewhere, okay? And what we're wanting to do is to help people see how they can be prepared for the buy of a lifetime, because it would not surprise us to see the crash of a lifetime. That's why it's so important to limit the losses so we can be prepared to catch the next wave. So this is a year ago, and while we're looking at the U.S. market have a real tough time at it, we find that internationals were doing very well. So some of our clients saw their portfolios, let's think of it this way, take some of the air out of the U.S. balloon, and it moved to internationals outside of the U.S., and that's where the gains took place. And by the way, the U.S. market had a very good year, 2025. Internationals had a better year by a wide margin, and it looks as though that difference might continue to be occurring so far this year. We'll see. But again, it's let's look at where we can limit the loss over here and maybe catch some gains over there. That's not market timing. That's looking at the account every day. Do we want more of this, more gains, more losses, or do we want to see what we can do to limit the loss over here and see some gains over there?
Got it. Wonderful. Hey, John, what's your website for our viewers?
Got a new one, johnlgrace.com.
johnlgrace.com. Really good information, John. And I will tell you, this is the first time I've heard this approach and this strategy, which is very appreciative because I like what I hear, and I'm surprised I haven't heard this before. We're less than
To
30.
your point, yeah, I'm sorry, go ahead.
Well, go ahead. Go ahead.
Well, and see, it surprises me too. And this is one of the reasons why I'm banging the drum. And please understand, we pay for research, Rick, and the research team said in '06, '07, be not surprised, this is how I put it, to see both stocks and real estate have a tough time. No one was saying that. So we started saying to clients, hey, we don't know when, we don't know how bad it might be, but let's see what we can do in the event there's an upchuck here or there. How can you play the game so that you're not sorry? And then praying for that Hail Mary pass and for the recovery. Okay. So we've been actually studying, we started studying active management businesses to do this for clients starting in like 1999. And each time we go and look, we're more and more impressed. So we started telling people, maybe better to be lucky than good, January of '07, Rick. Okay. Hey, Rick, we've had all these passive accounts. Now, we think it might be smart for you to move some money into the actively managed accounts. Some people said yes. Some people said no. And then 2008 comes along. We see them again in 2009. And the ones who said yes said, ooh, thank you. And the ones who said no said, ooh, is this what you were talking about? Yes, I couldn't tell you when, but I could tell you what we can do. And the good news is you're making contributions, so this doesn't hurt you. But if you were taking withdrawals, it'd be a vastly different story.
All right, John Grace, good stuff. And as someone who knew and interviewed Franco Harris, I agree. You don't want to depend upon the immaculate reception to pull your portfolio.
Well put.
John Grace, good stuff. Thank you for joining us.
My pleasure, my friend.
Back with more after this.